The real estate market is constantly evolving landscape shaped by economic forces, investor sentiment, and macroeconomic policies. As we move into 2025, multifamily real estate investing finds itself in a pivotal moment. A combination of rising interest rates, shifting demographic trends, and emerging technologies is reshaping how investors, developers, and financial institutions approach the sector. Understanding these shifts is crucial for making informed investment decisions. The interplay between supply and demand in multifamily housing remains highly sensitive to macroeconomic conditions. Factors such as inflation, wage stagnation, and changing consumer preferences directly impact rental affordability, vacancy rates, and long term property valuations. Investors who can interpret these underlying trends will be better positioned to capitalize on opportunities while mitigating risk. Today, we're going to dive deep into the structural changes affecting multifamily real estate investing, drawing highlights from the latest discussions at NMHC or the National Multifamily Housing Council meeting. We will analyze distressed asset trends, capital flow, and emerging investment opportunities. By examining these key factors, real estate professionals can develop a more nuanced understanding of what 2025 can hold in the multifamily sector. So let's start off with the rising interest rates and capital market shifts. One of the most significant factors influencing real estate this year is the continued impact of higher interest rates. After years of historically low borrowing costs, the Federal Reserve's tightening policies have forced investors to reassess their strategies. The cost of capital has increased, making traditional financing structures more challenging. As a result, investors must explore creative capital solutions such as joint ventures, preferred equity structures, and alternate financing model. Higher interest rates have also placed pressure on property valuations. Cap rate expansion driven by higher borrowing costs has forced investors to reevaluate their asset pricing. Properties that were once considered lucrative based on compressed cap rates may now struggle to maintain their valuations, especially in secondary and tertiary markets. Distressed assets, once rare in the post pandemic recovery, are becoming a more prevalent feature of the multifamily landscape. Institutional investors, private equity firms, and real estate investment trusts, REITs, are adjusting their strategies accordingly, and some are focusing from high market growth areas to more stable, cash flow oriented investments. Others are taking a wait and see approach, anticipating potential buying opportunities should economic conditions create further distress. Now, let's jump into the demographic and lifestyle changes affecting multifamily demand. Beyond financial market dynamics, shifting demographics are altering the fundamentals of multifamily. Millennials, the largest segment of renters, are aging into their prime home buying years. However, affordability challenges and rising mortgage rates continue to keep many locked into the rental market. At the same time, Gen Z renters are entering the workforce with different preferences than their predecessors. This younger cohort prioritizes flexible location and amenities that cater to remote work and hybrid lifestyles. Developers who fully understand these evolving needs are reimagining properties with more co living spaces, built in co working areas, and tech enabled smart homes. A growing emphasis on sustainability is another major shift. More renters are seeking energy efficient buildings, access to public transit, and eco friendly amenities. In response to investors and developers, they're placing greater emphasis on green certifications, carbon reduction strategies, and smart energy management. These elements are no longer just differentiators, but essential components of a competitive market assessment. So, here are some emerging investment opportunities. Despite economic headwinds, 2025 presents numerous opportunities for forward thinking investors. One notable trend is the rise of built to rent communities, BTR. As affordability issues push more would as affordability issues for would-be homebuyers into the rental market, demand for single-family rental communities continues to grow. Investors who can tap into this segment stand to benefit from the stronger demand while diversifying beyond traditional multifamily investments. Another opportunity lies in the value add properties. Investors can acquire and reposition underperforming assets through strategic renovations, operational efficiencies, and improved property management. They stand to capture upside. In a higher rate environment, these strategies become even more critical as organic rent growth slows. Additionally, adaptive reuse projects are gaining traction as investors seek creative ways to repurpose existing properties. With the rise of remote work and shifts in commercial real estate demand, some office building, hotels, and retail centers are being converted into multifamily housing. This approach not only addresses housing shortages, but also provides investors with unique opportunities to unlock overlooked assets. So, as we enter 2025, multifamily real estate is at a crossroads. Higher interest rates, shifting capital market dynamics, evolving renter demographics. As we enter 2025, multifamily real estate investing is at a crossroads. Higher interest rates, shifting capital market dynamics, evolving renter demographics, and the push for sustainable housing are all reshaping the investment landscape. While challenges exist, so do opportunities for those who adapt those changing conditions. Investors who leverage data driven decision making, adopt flexible financing strategies, and align with emergent market trends will be well positioned to thrive, whether through build to rent, BTR, or value add investments, or adaptive reuse projects. The key to success in 2025 will be agility and strategic foresight. By understanding the fundamentals that we're seeing in 2025, investors can navigate uncertainty and uncover new avenues for growth in the multifamily sector. So let's jump into the coming wave of distressed deals, structural and economic analysis. Distressed real estate transactions emerge in response to external economic stressors, primarily driven by financial instability, interest rate hikes, and liquidity contractions. Following the post pandemic real estate boom, which saw levels of capital deployment, the market has now entered a correction phase. Many investors took advantage of historically low interest rates to acquire assets at peak valuations, often using aggressive leverage. As borrowing costs rise, these capital structures are coming under immense pressure, creating a wave of distressed opportunity. The Federal Reserve's policy adjustments aimed at combating inflation have significantly impacted real estate markets. Interest rate hikes have increased financial costs, leading to a rise in cap rates and declining asset values. The once abundant liquidity that fueled rapid acquisitions has tightened, making refinancing options scarce and expensive. Many property owners now face negative leverage where their financing costs exceed their assets' income growth. This scenario is particularly problematic for owners who relied on short term floating rate debt, as refinancing in today's elevated interest rates often leads to cash flow shortfalls. Historically, economic recessions have been a primary trigger for distressed asset sales. In downturns, property values decline while credit markets become more restrictive, leaving highly leveraged owners with limited refinancing options. The combination of rising expenses, reduced lending availability, and declining valuations force some property owners to sell their assets below market value, creating buying opportunities for the well capitalized investors. So, here are some key indicators of distress in the current market. These include loan maturities and refinancing risk. A significant volume of commercial real estate loans will mature in 2025, requiring property owners to either refinance or sell. With higher interest rates, refinancing at comparable loan to value (LTV) ratios is becoming more difficult. Many owners will inject additional capital or accept unfavorable terms, which may not be viable for investors. Rising delinquencies and defaults are on the rise. The percentage of commercial mortgage backed securities (CMBS) loans in delinquency has steadily increased. Office and multifamily properties, in particular, have seen rising debt rates as tenants struggle with affordability and changing occupancy trends. We're also seeing a decline in property values, mainly due to cap rate expansion, has led to declining assets. Properties purchased at the peak market prices under low cap rate assumptions are now worth significantly less. And as a result, some owners are underwater on their loans, mainly in markets with high supply growth and softening demand. The institutional buyers are in a retreat mode from riskier assets. These institutional investors have shifted away from opportunist value add deals in favor of the more stable core assets. This retreat from the riskier investments have left many leveraged properties without buyers or additional capital infusion, increasing the likelihood of a distressed sale. Now, here's where we see the sectors that are most vulnerable to distress. While distress is spreading across multiple asset classes, certain sectors are more exposed than others. So, with multifamily, high supply growth, rising vacancy rates, and expiring rent concessions are squeezing property revenues. Investors who relied on short term debt to finance deals that compress cap rates are mainly vulnerable. The office sector remains under severe stress due to remote work trends and declining tenant demand. Many office buildings in older properties in secondary markets are struggling to maintain occupancy and justify pre pandemic valuations. Retail While some of the segments of retail real estate have stabilized, malls and underperforming shopping centers continue to face headwinds from e commerce competition and shifting consumer behaviors. Now, where are the opportunities? For well capitalized investors, the current environment presents some really unique deals. Distressed asset sales often provide a pathway to acquire high quality properties at significantly lower discounts. Investors with liquidity, strong operational expertise can deploy several strategies, including loan to own strategies, purchasing distressed debt at a discount that can allow investors to take control of the property through foreclosure or loan workouts. Recapitalization deals, partners with struggling owners to inject fresh capital in exchange for equity positions or preferred returns, can be an attractive entry point. Opportunistic acquisitions, targeting assets with long term value potential but short term distress, mainly in high growth markets where fundamentals remain strong. So, the combination of hiring borrowing costs, declining property values, and tightening liquidity is setting the stage for a wave of distressed asset sales. Investors who can navigate these conditions with patience and strategic capital deployment will find opportunities to acquire properties at attractive valuations. As the market recalibrates, those with foresight and financial discipline will be well positioned to capitalize on the coming wave of distressed deals. So let's jump into the historical precedents and their relevance to 2025. The Great Financial Crisis, GFC, of 2008 remains one of the most important case studies for understanding real estate distress ever. During that period, excessive leverage, loose underwriting standards, and a speculative housing market fueled a collapse in property values. As financial institutions tightened lending and liquidity evaporated, many property owners were forced to sell at steep discounts. Investors who maintained liquidity and had a long-term perspective, such as Blackstone's real estate division, were able to acquire distressed assets at deep discounts, generating massive returns in the following decade. However, 2008 was driven by residential mortgage-backed securities (RMBS) and the collapse of subprime lending. Today's distress cycle is primarily unfolding within the commercial real estate sector. Unlike the past, where overextended homeowners and financial institutions triggered a systemic crisis, the current market stress stems from commercial loan maturities, higher interest rates, and tightening credit conditions. By 2025 is over 150 billion multifamily loans will come due. Many of those were financed during 2021 low interest rate environment as rates between 2 and 4%. With refinancing rates now exceeding 7, many property owners will struggle to meet debt service ratio DSCR requirements. As a result, forced sales, distressed asset auction, and lender workouts are expected to rise significantly. So the key to 2008 is that disciplined investors who can maintain liquidity and adopt the contrarian approach will be well positioned to acquire valuable properties at discounts. Market downturns tend to separate professional investors from speculative buyers who overpaid during periods of excessive optimism. Key indicators of distress in 2025 will be, again, loan maturities. A significant amount of multifamily office loans will mature over the next 12 to 18 months. Owners who finance during the low rate time will struggle to refinance. Occupancy shifts in Class A properties, high end multifamily developments were aggressively built over the past decade, now face oversupply issues. Developers targeted luxury tenants, but economic uncertainty has weakened demand for key markets. Class A properties are experiencing higher vacancies, forcing landlords to reduce rents, which in turn places downward pressure on Class B and workforce housing assets. Let's chat rising delinquency and rent payments. Inflation and wage stagnation have eroded renter purchasing power, leading to higher delinquencies. Markets that saw aggressive rent growth post pandemic, such as Austin, Phoenix, and Miami, are now experiencing higher eviction rates and rent concessions. Landlords carrying high debt burdens will struggle to maintain cash flow, leading to an increase in distressed sales. So, how do you capitalize on distress? For well capitalized investors, market downturns do present unique opportunities. Those who deploy strategies of capital and focus on distressed asset acquisition can benefit from below market deals and favorable terms. So, here are some things to look out. Track loan maturity. Investors should use commercial real estate data sources to track upcoming loan maturities. Identifying assets facing refinancing pressure can help secure off market transactions before they hit the foreclosure process. Multifamily and office assets with expiring floating rate debt are prime targets for distressed acquisitions. Partner with lenders. Many banks and private lenders are looking to offload non performing loans, NPLs. Building relationships with lenders, allowing investors to negotiate loan workouts, short sales, or discounted note purchases. Some lenders prefer to sell distressed loans rather than foreclose, creating opportunities for investors who can step in quick and provide a solution. And utilize alternative financing. Creative structure can reduce reliance on traditional debt. Seller financing, negotiating with distressed owners to carry back financing is favorable. Loan assumptions, which is taking over existing low rate financing. Preferred equity partnerships, which is providing equity infusion in exchange for priority returns. And also think about bulk purchases. When we look at institutional investors and private equity firms who are trying to rebalance, they may offload multiple properties at once. Investors with access to liquidity can negotiate bulk acquisitions at significant discounts. So REITs and family offices looking to exit over leveraged positions may be willing to sell assets and portfolio blocks to reduce exposure. Well, 2025 is evolving. Look for distressed deals because this differs from 2008's residential mortgage collapse, but the fundamental principles remain the same. High leverage, rising financial costs, and economic uncertainty creates forced selling opportunities. Investors who prepare now by tracking loan maturities, monitoring delinquencies, and leveraging alternative financing will be positioned to capitalize on deeply discounted assets. And as history has shown, those who invest during downturns often emerge as market leaders when conditions stabilize. So, who will control 2025? Is it institutional or private capital? The real estate investment landscape is going on foundational transformation. The past decade, institutional investors, including REITs, pension funds, and sovereign wealth funds, dominated the multifamily sector, deploying capital in unprecedented levels. However, as we enter 2025, private capital is reclaiming its influence, stepping where institutional investors are pulling back. This shift is being driven by economic uncertainty, changing regulatory environments, and increased capital costs. Institutional investors, once the driving force behind large scale acquisitions, are now focusing on liquidity preservation, while family offices and high net worth individuals and boutique investment firms are emerging as more flexible and opportunistic market. So, why are institutions retreating? Several key factors are pushing these investors to sidelines. Higher risk premiums. Institutions are prioritizing stability and risk adjustment returns. Rising cap rates and economic uncertainty have made many acquisitions unviable under traditional institutional underwriting. Now, increased volatility in asset pricing is deterred institutions that require more predictable cash flow. Capital constraints. Many institutional investors are prioritizing liquidity preservation over aggressive acquisitions. Pension funds and endowments are facing increased withdrawal demands, reducing available capital for new real estate investments. And the rising cost of private debt and fund level financing has made institutions more cautious. Additionally, regulatory challenges. Cities such as New York, LA, and San Francisco have enacted strict rent control laws, limiting revenue potential. Increased affordable housing mandates and tax burdens in major metro areas have made institutional ownership less attractive. New ESG, environmental, social, and governance requirements impose additional compliance costs on large institutions, further reducing their appetite for risk. Underperformance of public REITs broader stock have broader stock implications, leading to capital outflows from institutional investors. As REITs struggle to deliver shareholder returns, institutional investors are redirecting capital to alternative assets, private credit, and infrastructure projects. Large fund managers seeking to avoid illiquid positions are exiting value add opportunities. The rise of private and family office investors with institutional capital retrenching, private investors are stepping into the void. Family offices, high net worth individuals, and boutique investment firms have significant structural advantages in today's real estate market. Flexibility, which, unlike institutions with really rigid mandates, private investors can pivot quickly and take advantage of mispriced assets. Family offices are less constrained by short term return requirements, allowing them to weather market volatility. Private capital investors can utilize seller financing, joint ventures, and off market deals to secure assets at favorable terms. So, while institutions must deliver quarterly results, private investors can adopt a patient capital approach, maximizing long term appreciation. And here are some specific strategies for capital investors, private capital investors this year. Focus on value add. With institutions avoiding operationally intensive assets, older properties with below market rents present lucrative opportunities. Investors who can renovate, reposition, and optimize management will see strong rent growth, even in a higher rate environment. Smaller assets under 100 units are particularly attractive as they often fall below the radar of larger institutional buyers. You also want to leverage the joint venture syndications. Smaller investors can partner with experienced operators to syndicate deals. Cities such as Nashville, Raleigh, and Tampa are seeing population growth and business friendly policies attracting private investment. Secondary markets often offer better cap rates and rental yields. And while institutional investors are driven by quarterly performance metrics, private investors can hold assets through short term volatility. Investors with a 5 to 10 year outlook can benefit from compound rental growth, property appreciation, and loan paydowns. So, we've gone over a lot here. The real estate investment landscape in 2025 is experiencing a significant power shift. Institutional capital, once dominant, is retreating due to rising interest rates, tighter lending conditions, and regulatory pressures. In its place, private investors, family offices, and boutique firms are stepping in, taking advantage of mispriced assets for value add opportunities. So, for those with flexibility, liquidity, and a long term mindset, 2025 presents a rare opportunity to build generational wealth through strategic estate acquisitions. As capital shifts from institutions to private investors, those who adapt this new market structure will emerge as the next generation of real estate investors. So here are your final takeaways. Track distressed asset, Track distressed assets, capitalize on private capital's rise, and target high growth markets. Secondary and tertiary cities are outpacing primary markets in job growth and migration trends. So the time is now to move. Investors who wait for certainty will miss out on the best deals. So position yourself strategically, act before the market rebounds, and build lasting wealth. So if you want exclusive insights on upcoming distressed opportunities, let's connect. Thanks for watching.